for joining us. My name is Brian Russell, and I'm the chapter president for the CCIM Institute Southern California chapter. Today, we have an expert in 1031 exchanges that will give you all the information and knowledge you need to know to make an informed decision on which 1031 investment vehicle works best for you or your clients. Ladies and gentlemen, please help me in welcoming JP Ledesma, a 1031 expert and principal for Beacon 1031. JP?
Brian, thank you very much for taking the time to do this. So I just wanted to very briefly let you know that I specialize in 1031 exchanges, specifically helping people go from active to passive real estate investments. And the way I can assist, they're your traditional brokers essentially, is helping to unlock the listing. So if you have a hesitant seller, we have a plethora of options for them to exchange into and be passive. Now, when they go passive, right, there's three different major options, right? There's your traditional single-tenant triple net lease type of property. There's properties that are in the Delaware Statutory trust structure. And then there's also the direct title security. They all have their pros and cons, but letting them know what their options are and that they're always assured of being able to complete their exchange is extremely helpful. The other is, even if their primary target is to maintain control of a single tenant net lease property or a strip mall or what have you, it's always good to have a backup plan.
Right? Sure is.
And as we've discussed previously, it's very easy to identify properties in 45 days. What's not easy is to identify and obtain all necessary environmental and other due diligence materials in a timely manner, right? And get control. So that's why I think it's always wise to have a backup plan.
Absolutely. Plan B, many opportunities, plan B is what happens, right? Because plan A somehow didn't materialize. Well, excellent. So that's an excellent segue to an introduction of those three vehicles. Since you mentioned single tenant net lease first, why don't we start with that one? You can explain the pros and cons and we can move on to the next two.
Right. So your traditional triple net lease, right? A lot of people like that because they have control. Control essentially meaning they decide when they're going to sell the property, right? But other than that, you don't really have control. Once you're in the contract with that corporation, that's it, right? The tenant eventually at the end of the lease has the option to either renew or not renew, whatever the contracted rate of rental rate is what it is throughout the lease term, et cetera. And then of course you're hoping that they're going to maintain the property to your standards. Right?
That's right. And the investor's really attracted to the balance sheet and the creditworthiness of that single tenant net lease.
Correct. Right? So the longer the lease, so when you buy a triple net lease, you're really buying two things, right? You're buying the property, and then you're also buying the lease, right? So if you have, for example, the bank that's too big to fail on a 20-year lease, right? That lease is going to be worth more than if the same too big to fail bank has 2 years remaining on the lease.
Exactly.
And then the other thing is the too big to fail bank is going to have a much better credit rating than the mom and pop hot dog stand, for example, right? So as a result, capitalization rates with the lower risk profile are going to be lower. In other words, you're paying more for that future cash flow. Now,
that's right.
The big thing that we look at, in all these syndications, if we're looking at triple net lease, is any monkey can know what the credit rating is today. But, when it comes to due diligence, what you want to look at is what the credit rating is likely to be 5, 7, 10 years from now, right? Because that's when you're most likely going to be exiting. The reason you would exit then is most commercial loans have, even on a 30-year amortization, either 7 or 10-year term. So all of those items are things we want to look at.
Now, I've heard some people refer to these single-tenant net lease properties as buying a corporate bond, but this bond actually has real estate, and therefore you could depreciate a lot of the income. Is that an accurate representation?
Correct. So for any type of real estate, there's a depreciation pass-through where, whether you're by it yourself, it's through the direct title security
Mhm.
or in the Delaware Statutory Trust entity.
Mhm.
How it's unlike a bond is you don't know what the value is going to be. A bond has a face value. A corporate
Mhm.
bond is $1,000.
Mhm.
Now, there can be a lot of variations. For example, a certain drugstore was recently downgraded, right?
Mhm.
So in that downgrade, by the credit rating going down, the value of the lease goes down.
Mhm.
The other issue is that I've heard a couple clients, actually, one I just talked to a couple months ago, he had a loan in place that was basically a very favorable loan, but it was a CMBS,
Mhm.
commercial mortgage-backed security. And in order to maintain the loan, they had to have the tenant maintain a certain credit rating. That downgrade on the credit was a technical violation of the loan. Now the bank is sweeping all the cash flows.
Wow.
So, uh, you know, that's the other side of the coin. And that's why I say, looking at not just what the credit is today, but what
Mhm.
it's likely to be in the future.
Right. Okay. All right. That's a pretty good understanding of, or at least a 101 on single tenant net lease properties. And by the way, for anyone listening, we'll have contact information. So if you'd like further information from JP on any one or all three of these options, contact information will be provided in the notes below. So sit back, relax, and enjoy the rest of the podcast to know that you can ask some follow-up questions. All right, excellent. So the second one was the Delaware Statutory Trust, correct?
Right. So Delaware Statutory Trust is becoming more known, and that's just
Mhm.
a vehicle. You think of it as a wrapper that holds a property, just as you could own a property through an LLC or some
Mhm.
other entity, right?
Mhm.
It just so happens that this particular type of trust is recognized as the IRS as being a
Mhm.
pass-through entity.
Mhm.
Therefore, uh, as far as taxation goes, it's just like any other normal real estate. However, you have a percentage ownership, not 100%
Mhm.
of the property. And if you're interested in being a passive investor, it's often an excellent option. And the
Mhm.
reason is it's as passive as a land lease, right? So whoever created that syndication, they're the ones that are making sure that that single tenant lease or whatever kind of property it is, that the insurance is being paid, the property taxes are being paid, the maintenance is done, etc. So
Mhm.
literally, you have nothing to track. It's 100% passive.
Mhm.
The downside is this, right? You don't decide when to exit. Somebody
Mhm.
else does. Now, there's going to be a time frame with which that's going to happen, and then the other is you can't refinance. There's some other limitations, right? You have no control, right? So
Mhm.
that's a person's big hesitation typically on those, especially if they've built up their real estate empire and they've been active real estate investors, or maybe they had property managers that they were very close to, right? They were kind of used to or accustomed to managing the managers, right?
Mhm. Mhm.
Uh, so, and then the other positive on the Delaware Statutory Trust is technically you could have close to 2,000 investors in one entity, which
Mhm.
means you have the possibility of having very large institutional quality properties,
Mhm.
and you're able to obtain fractional ownership with a relatively small amount of money, maybe $100,000, and you have the ability with relatively small capital to diversify, right? So you could
Mhm.
essentially say, okay, I want some of this to be in a single tenant, triple net property or portfolio properties, some in multifamily, some in self-storage, some in student housing, some assisted
Mhm.
living, et cetera, et cetera. So that's also good for someone that's looking to diversify the tenant mix, the property type, and the MSA or that they're investing in.
So now, is it true that different Delaware statutory trust groups specialize in different sectors? Like some might specialize in industrial goods movement, some might specialize in office properties or retail. Is that or multifamily?
Correct. So we work with, on the Delaware Statutory Trust side, a lot of the small sponsors don't have offerings all at the same time, but
Mhm.
about 52 different sponsors.
Oh. Mhm.
And many specialize, and the larger companies tend to have multiple sectors available.
Okay,
If that makes
good.
sense, right?
So there's choices. So if you, as an investor, you have a client that's an investor that really wants to get into the goods movement space, there's probably a DST that will have an offering that will focus on that if that's a desire of your client.
Right. So we have a few right now that are single tenant industrial buildings and a few that are portfolios of industrial buildings. So,
Okay.
one DST, you might be buying 6 industrial buildings,
Mm-hmm.
right? You invest in the one entity.
Mm-hmm.
Uh, and then, of course, you have all the same considerations with any type of real estate investment is, how is this tenant going to perform,
Mm-hmm.
et cetera, et cetera. How well is it going to be managed by the sponsor? And that's it. So again, so like, you know, for example, we have one company we work with that just specializes in student housing. But there's another company that does student housing too, but they have investments or DSTs in maybe 5 different sectors,
Ah.
right? Or 5 different types of real estate.
Mm-hmm. Mm-hmm.
So there's a lot of variability there.
Sure. Now, how would someone go about, a prospective investor, go about doing their due diligence on a DST operator? Can you check their batting score and how they've performed?
Yes, so some of the larger firms tend to be very open about their past performance,
Mm-hmm.
right? So some that I like to work with, they'll do that. It becomes quite harder when you're looking at smaller firms,
Mm-hmm.
and sometimes there are very large firms that are um, now have a track record, but just not in this space, right?
Wow. So
So I'll give
you
you an
can help.
example,
You
right?
can help the investor sort through that and make good informed decisions.
Correct, as best as we can. So basically, there's 3 levels of due diligence, right?
Mhm.
There's like the sponsor level, which there are some law firms that specialize in that niche, which to me is not worth a whole lot. Then there's the usually the individual broker dealers have their own due diligence, and then myself and my business partner, I think that we add value because we have investment sales backgrounds,
Mm-hmm.
and we're able to look at things more from a real estate perspective as opposed to the accounting bean counter perspective.
Nice.
Makes sense.
And now that we're speaking of that, we're going to be speaking of a number of taxation issues and legal issues, and neither you or I are attorneys or accountants. So the message I want to share is that if you're watching this and you represent a client that's selling a property, let's just say it's a multifamily property, and they want to sell and they want to consider you for their 1031 options, that you're going to be able to sit down and understand the risk profile of that particular client and give them options that are consistent with that profile, and you're going to help guide them all the way through that. But most importantly, you're going to work well with their CPA or their attorney to make sure that their legal and taxation considerations are brought into the whole mix of this 1031. Is that an accurate statement?
Yes. So if it's someone, a lot of it depends on the situation, right? So we talk about their needs, where their basis is, what kind of debt replacement, do they want to take equity out of the deal and put some cash in their pocket? Do they want to leverage up and do a cost segregation study, et cetera, et cetera? What's their liquidity needs? What kind of hold times do they want? Are they growth oriented? Do they just want safety of cash flow? So there's a whole plethora of questions, and everyone's circumstance is unique.
Mm-hmm.
So what we do once we build a profile of the goals and we really understand, we can go ahead and work up something that we believe will meet those goals as best as possible.
Excellent.
With the highest potential return on equity, right? Because it's not just the cash flow, it's what is this going to look like in 7 years when these things are selling, right?
Right. Indeed.
So, with a simple thing like someone's coming out of a single family residential property, there's not much to it. But if someone's selling a larger property where they're dealing with more assets, then we have more to work with, if that makes sense, right?
Sure
Once you
does.
get
Yeah.
into that, once you get into that few $1 million range, we're able to add value to them. And the other thing to consider is it doesn't have to be all or none, right?
Mm-hmm.
So I've had 3 transactions this year where people are doing 1031 exchanges on commercial properties, and then they use the bits and pieces, so to speak, we're just putting the DSTs, right? Because they didn't want to, they had leftover boot, Or actually, in two cases, I had people that just use highly leveraged DSTs to soak up debt,
Mm.
and then they're able to uh, have less debt on their single tenant properties,
Ah, okay.
right?
Excellent. And you touched on cost segregation. For those that aren't aware, that's an accelerated depreciation program that has been around for a while. But now, this particular year, you and I were talking before we started rolling that in January, we have a bonus depreciation. Can you touch lightly on that and perhaps invite people to call you with any specific questions on that? But bonus depreciation seems like a really interesting and intriguing tax savings that's just available this year.
Uh, well, I think it's actually, so what happened was when the quote unquote, I'm just going with the name, one big
Mm-hmm.
beautiful bill passed,
Mm-hmm.
it made bonus depreciation retroactive to, I think, January 20th or 21st of this year, right?
That's it. Mm-hmm.
So anything that is less than 27 and a half years,
Mm-hmm.
what would be known as, it could be what they call technically Schedule 1245 or 1250 property. Anything
Mm-hmm.
that you normally depreciate over 3, 5, 7, 15 years, you can now take 100% of that depreciation in the first year. Of course, if that loss is less than what you generated through all your real estate or through all your passive investments, you can carry that loss forward.
Yeah.
And also, it's not mandatory, right?
Mm-hmm.
It's optional.
Elective. Mm-hmm.
So yeah, so there's a cost segregation, whole nother discussion,
Mm-hmm.
probably would last a long time. But
Mm-hmm.
one thing I did want to get to, and we probably should have done
Sure.
it first because it's the most, which is the direct title security.
Yes, the third option that you
Right.
mentioned earlier. Excellent. Yes, please.
Which I think is a nice hybrid between the two. So
Mm-hmm.
on direct title security, you, just like it sounds, have direct title, you have control of the properties, and we're working with the corporation. What they do is actually triple net leases on single family residential properties. So very different, right? Because typically you don't see that, right? You're used to
No.
it on commercial property. So it's
Right.
credit rated company, investment grade, I should say, credit
Mm-hmm.
rating. It's a 10-year lease. Um, so the positive it is are that you go in, you can control when you sell. Of course, that lease stays in place for the 10-year term, and you do have the option to sell whenever you want, which is good for people if they're worried about liquidity for heirs or what have
Mm-hmm.
you.
Mm-hmm.
It does also provide optionality for debt,
Mm-hmm.
non-recourse debt, anywhere from debt-free all the way up to 65% loan to
Mm-hmm.
value, depending on what you might need to replace for your 1031 exchange. So
Mm-hmm.
just to recap, to remind people, if you had debt on the property you're sold, the down leg, you need debt to be replaced on your up leg, the
Mm-hmm.
replacement properties.
Mm-hmm.
Uh, these houses are typically in the Sun Belt or Midwest.
Mm-hmm.
The way it would happen, the basic procedure is you go, you decide this is something you want to pursue. Um, we put in a request for proposal, and we let them know the parameters we're looking for. And there's different tiers of properties, right? So typically, the higher quality areas are going to have lower cap rates, hence
Mm-hmm.
lower cash flow.
Mm-hmm.
Less desirable,
Right.
typically, or more, uh, I guess you could say, not economically advantaged areas. The other thing on the triple net lease is typically this appreciation homes. They'll start it at a lease rate typically above market for the
Mm-hmm.
area.
Mm-hmm.
They're 100% responsible for just like any other triple net. They pay the insurance, they do the maintenance, et cetera, et cetera. And there are some parameters that the homes have to fall in, right? So a lot of them
Mm-hmm.
are new construction. They're not any older than like 2010 construction. They have to be newer than that.
Mm-hmm.
And then, of course, the company putting the deal together, they do their own inspection before the deal's consummated. So you decide, well, I want, and I'm just doing as a hypothetical, I want to buy some houses in the suburbs of Columbus, Ohio,
Mm-hmm.
Indianapolis, Cincinnati, Huntsville,
Mm-hmm.
right? You buy these, but the minimum investment or increment is the price of a home, right?
Mm-hmm.
So minimum increments are going to be 200, 350, 400, whatever the price of the home is.
Mm-hmm.
Uh, Again, I think a lot of people like it. And also, unlike a Delaware statutory trust where whatever the deal is when you get in, it doesn't change here, you can always have optionality to refinance. So, for example, you could go in debt free and decide a year later uh, you want to refinance, pull some money out, right? Something of that nature, that's always
Mm-hmm.
an option. Or
Mm-hmm.
if you go in now with debt and interest rates are down 2 years from now in a meaningful way, you can refinance those properties. And that's
Mm-hmm.
totally up to you. Again, they make non-recourse debt available all the way up to 65%.
Mm.
So I kind of view that as a nice hybrid, so to speak.
It
It's
is.
very unique. So
And the
that's
direct title notion might be more appealing to some that want to have a little bit of control. But you're right, it's a nice hybrid. It's not as passive as the Delaware statutory, but it's not as active as the single tenant triple net.
right. I would say it's on par with a triple net, except again, the, in this particular case, like even if you have a triple net, like especially
Uh-huh.
on a strip mall or what have
Uh-huh.
you still have to work out what the cam fees are on the
Right.
right.
And every year you have to revisit that.
Right, and you still have to work out, are the property tax, or you have to go back and make sure the tenant's paying the insurance that they contractually should have, right?
Right. Uh-huh. And all
In
the
this particular instance, you don't have that layer, right?
nice.
So this other company, they're 100% on the hook
Uh-huh.
for uh, the insurance, maintenance, et cetera. And then their goal is to create a real estate investment trust and have this as a funnel of properties that
Uh-huh.
feed that REIT. So
Mm-hmm.
they have a financial incentive to maintain the properties to a high standard.
Nice. JP, this has been extraordinarily informative, and I know our audience is going to sincerely appreciate your expertise. Do you want to take a minute or two and wrap up of the three property 1031 options that you mentioned, and then, like I said, your contact information will be below, and I certainly hope our viewers will take it upon themselves, take the initiative, give you a call, and ask some deeper questions on any one of these options.
Right. So the other thing about direct title securities that might
Mm-hmm.
interest real estate professionals is
Sure.
that it pays a real estate commission,
Ah,
right? So
yeah.
it's kind of a real hybrid between a real estate transaction and a security. So uh, depending on location and the amount or what have you, it's usually 2 and 2.5% in that range to the
Yeah.
buyer's representative, right? I can't
Great.
guarantee anything, but that's what we're
Mm-hmm.
looking at.
Mm-hmm.
And also it's on the value, not the equity invested. So if you look at Delaware statutory trusts, for example, if I'm securities licensed, I get paid on equity, I don't get paid on value, right?
Mm-hmm. Mm-hmm.
CTS, someone comes in with $1 million, they go 50% loan to value, you're getting commission on the 2 million, not the 1 million.
Correct.
So
Good
that's
differentiate.
right. So there's the very clear way to get paid as a real estate professional. To the buyers have control of the property. 3, it's passive. 4, you have to consider, over any 10-year cycle,
Mm-hmm.
uh, if you're buying in a good location, residential is held up in terms of value, right?
Mm-hmm.
So unlike a traditional triple net property, right, where typically your lease is degrading over time, here it doesn't matter because you're the dynamics of residential properties are slightly different in that people are willing to pay higher because they view it as a primary residence. It's not a pure investment, right? So if you were to put that for sale in the marketplace, they typically demand a price that's higher than would logically make sense as an investment property.
Okay. Excellent. Well, thank you very much, JP. Your information and your expertise and your knowledge on on these three 1031 options are very, very valuable. Again, the name of your company is Beacon 1031. You are a sponsor for the Southern California chapter of the CCIM Institute. For that, we thank you very much as president of the chapter. It's been a pleasure to have you as a sponsor, and I certainly hope our members and our prospective members and agents and brokers all throughout our area are listening to you and be able to take advantage of your good expertise and your knowledge and your
At the
capacity for
beginning,
you and your
this
partner to become
podcast is not
1031
an offer to
and
buy
help their
or
clients
solicitation to sell
achieve
security.
their real
The
estate
podcast
goals.
is a discussion
All right,
pertaining
Brian,
to
thank you.
one or more investment
welcome.
strategies and or asset classes, and is not a discussion of any specific offering, past or present, of securities. As a reminder, there is no guarantee that any investment or strategy will perform as targeted. Past performance is no guarantee of future performance, and any investment involves risk of the loss of some or all principal invested. The podcast contains statements intended for educational hypothetical purposes only, as not to be construed as a promise of performance. Information presented herein reflects the opinions of the speakers and is from sources believed to be reliable, but all information is subject to change. You should always speak to your finance and or tax professional prior to investing. Securities offered through Emerson Equity LLC, member FINRA SIPC, only available in states where Emerson Equity LLC is registered. Emerson Equity LLC is not affiliated with any other entities identified in this communication.